The starting point has to be Lehman Brothers going into bankruptcy protection earlier this week.
Bear Stearns and Merrill Lynch, colossals of the investment banking industry that survived the Great Depression, have all collapsed within the last 5 months.
American International now found itself in trouble and had to borrow money from the US Fed. That was 2008. We all were younger in those days. Anyway, the effects and the ripple effects in the banking sector and throughout the entire economy led to the great financial crisis. Our next guest predicted it in 2007, and perhaps just worryingly, he sees similar dynamics at play. But if you take a look there, you see multiple different risks considered in isolation, but when you connect them all together, they do become connected. For instance, the growth you've got private credit and artificial intelligence, but the way they are linked and the relationship between the two creates internal and possible massive dislocation. You then add in, for example, physical risks. You've got the war with Iran. You've got the potential conflict in Taiwan. Major headwinds. Again, putting it all together, because what happens is, if I show you properly, once it all starts coming together and once one starts feeding onto the other, you end up with absolutely our good old friend, the circular economy. For instance, let's just take the possible conflict of Taiwan. The supply, just watch this, you've got Taiwan, then you've got the artificial intelligence boom because semiconductors will be severely limited. Then you've got knock-on effects to those who had invested throughout the system. As you can see, one leads on to the next. Richard Bookstaber is the author of A Demon of Our Own Design. He joins me now. Sir, this interlinking between it all, we've seen it before, and it begs the question, do we ever learn? It comes back to bite us. It's still got teeth and it still bites, but it comes with a different fur.
Yeah, this time it's hard to go back and learn the lesson because this is a new lesson. Up to now, the sorts of risks that we've had are financial. And you can learn from the previous financial crisis to understand the next. What we're seeing now is a new era. The issues with artificial intelligence is something that we haven't seen before. Private credit is a new and somewhat untested market. So I actually don't even think you can go to the past and learn a lesson. We have to look at this anew and take a fresh start towards it.
Okay, but when I heard about, and when we discussed this in our morning meeting, my initial reaction was to say, oh, well, that's all fair enough. But what does he want us to do? I mean, it's fair enough to tell us that, the sky may be falling, but unless you're going to tell me, well, I think you should do this, that, or the other, tell me, what do we do?
So I think you can look at it in three ways. There's risk, obviously, but with the risk, the other side of the coin is there's opportunity. But those are things the investor can do to placate where they're sitting in the situation. The other is, what can companies do? What can countries do? I'll focus on the first two because my background is risk management in the investment world. The first thing is to just say, things are riskier. If you were comfortable with, say, 70% of your portfolio in stocks up to now, if there's more risk, you might be comfortable with less than that if you want to have a similar amount of risk. So resetting your portfolio would be a start. The other part of it is opportunity. When the world is dislocating, there are opportunities, and we already know what's happening. We've seen it. There are some companies that are going to be the buggy whip manufacturers of 2028. But there'll be other companies that just ride the wave and exponentially grow on the basis of this. So that's the other side of the coin.
But then you end up with a sort of, today's a good example for us to be talking. I know you're talking bigger picture, but it's very difficult. You have a president who makes one comment and the market goes down. You have the next day, just on the strength of a comment, it goes back up again. Now, it's hard to ignore those gyrations and concentrate on the bigger picture when the knee jerk always draws us back.
Yeah. It's hard to get away from the day-to-day news.
Yeah.
This is happening, that's happening. But try to think, for most of us, our focus really, as individuals, and if you're a pension fund or a sovereign wealth fund, it's the same story, is longer term. We're looking at investments over the next 5, 10, 20, 30 years. So a lot of what we see day to day, even some of these issues with Iran, is noise in that perspective. So there's some discipline that you have to understand what is the time frame of your investing, and on that basis, what should you be focusing on in terms of risk.
Now, you talk of 2008. You remember and I remember my first financial crisis was Black Monday 1987. And we saw the Dow drop 24% in a day, and we thought financial Armageddon had come. The market recovered relatively quickly, and it recovered relatively quickly. I mean, it took longer in 2008, but you're saying, even for old-timers like me, this next crisis could have a much longer recovery period. Right,
and that's the point of the risk. It's whether the market goes down 20%, 30%, 50%, if it recovers in 2 to 4 years, for most people, if they stay the course, they'll be okay. But if the market's down for 10 years, 15 years, now that really matters. You know, if you are thinking that, say, the market's going to go up an average of 7% a year, which is fairly reasonable, if over a 10-year period, it's the same place it was at the beginning, you're down 50% from where you thought you would be. So it's that long-term focus that I think we need to have. We need to move away from just looking financial risk towards looking physical risk. And we need to get our time frame reoriented for the time it takes for physical risks to manifest themselves and work their way through.
Very difficult to do, though, isn't it? Particularly because you talk about rebalancing a portfolio. So you rebalance and you don't get the gains that you would like to see while the market continues, because you're waiting and waiting and waiting. But you need the gains if you're because of the dreadful pension situation that we have in most developed countries now. You need the gains if you're going to have a half-decent retirement.
Yeah. Well, this is, the secret weapon individuals have, and for that matter, pension funds have, is they have a time frame where they can be patient. If you're a hedge fund or an asset manager, you have to look month by month. We don't have to play that game. And so if we're seeing these dislocations and we understand them, we can wait in many cases until the dust settles and look more towards these longer term issues.
I'm grateful, sir. Thank you for coming in and talking to us. Thank you.
Thank you.